All right, guys, something big just shifted, and most people are still missing it. In just days, Beijing is preparing to tighten control over silver exports, and at the same time, panic is quietly spreading across the U.S. semiconductor industry. On the surface, these two stories look unrelated. One is about metals, the other is about chips and AI. But underneath, they are part of the same structural pressure point, and that pressure is starting to bite. This is not about headlines or politics. This is about inputs, constraints, and who controls the bottlenecks of the modern economy. For years, the United States believed it had the upper hand by restricting advanced chips to China. That strategy assumed one thing above all else, that hardware dominance alone could slow Beijing down. But reality is more complex. China did not respond by trying to win the same race on the same track. Instead, it began reshaping the track itself. While Washington focused on training ever larger AI models, Beijing focused on scale, cost, deployment, and the physical resources that make digital systems work in the real world. And now that gap in priorities is becoming visible. Semiconductors do not exist in isolation. They sit inside data centers. Those data centers consume massive amounts of electricity. They rely on power grids, cooling systems, industrial metals, and above all, silver. Silver is not a speculative side story. It is essential for chip manufacturing, solar panels, electric vehicles, and high-efficiency electronics. When access to silver tightens, costs ripple outward fast. That is why markets are nervous. This is also why U.S. chip executives are suddenly talking less about dominance and more about resilience. The fear is not that China will out-innovate the U.S. overnight. The fear is that China is methodically securing the physical foundations of the next technological cycle, while the U.S. remains focused on the software layer. Once that foundation is locked in, catching up becomes exponentially harder. This moment matters because it signals a transition. The chip war is no longer just about fabs and lithography machines. It is about energy, materials, and long-term industrial coordination. And silver sits right at the center of that shift. What looks like a narrow export decision is actually a signal that Beijing is ready to play a much longer and deeper game. Now let's slow this down and define the core mechanism at work, because without it, the rest of the story sounds exaggerated. At the heart of this shift are two competing models of technological power. The American model prioritizes frontier breakthroughs, bigger models, more parameters, and the pursuit of artificial general intelligence. This approach burns capital, energy, and time, but it promises prestige and theoretical leadership. The Chinese model is different. It prioritizes inference, deployment, and integration. Inference means using AI efficiently in the real world. Fast responses, low latency, predictable power use, affordable chips that can be deployed at scale across hospitals, factories, logistics networks, and cities. China leaned into this path partly by necessity. Export controls limited access to the most advanced training chips, so Beijing optimized what it could control: manufacturing scale, power availability, cost discipline. And this is where the silver story becomes unavoidable. Inference at scale requires massive hardware deployment. That hardware requires conductive materials. Silver is one of the most efficient conductors available, and it is extremely difficult to substitute without performance losses. Every solar panel, every power connection, every high-efficiency circuit quietly consumes it. This creates a choke point. Control silver, and you influence the cost curve of everything downstream. China understands this deeply because it has already lived through similar battles in rare earths and energy infrastructure. By moving to restrict silver exports through licensing and administrative controls, Beijing is not banning trade outright. It is introducing friction. Friction raises prices. Prices shape investment decisions, and investment decisions determine who can scale and who cannot. Meanwhile, the United States faces a structural mismatch. AI demand is exploding, but domestic power generation is lagging. Data centers are being built faster than grids can support them. Manufacturing costs are higher. Labor is tighter. In that environment, higher input costs do not just hurt margins, they slow deployment. That is the real risk, not collapse, but delay. Delay in AI is deadly because adoption curves reward the first system that becomes cheap, reliable, and ubiquitous. Beijing's strategy is not to outshine, it is to outlast. Silver is simply one lever among many, but it is a lever that directly connects digital ambition to physical reality. Meanwhile, inside the U.S. semiconductor industry, the tone has changed. Publicly, executives still talk about innovation and leadership. Privately, the conversation has shifted toward cost, inference, and survival in a far more constrained environment. This is why recent moves by major chip makers matter. The sudden rush into inference technology is not a coincidence. It is an admission. Training the biggest models in the world does not automatically translate into dominance if those models are too expensive to run or too slow to deploy. Inference is where value is captured. It is also where China has quietly built an advantage. Chinese AI systems are already embedded across consumer services, healthcare, finance, and urban management. They are not flashy, but they are everywhere. That ubiquity matters more than benchmarks. For US firms, catching up requires enormous spending, licensing, acquisitions, new chip designs, optimized for efficiency rather than brute force. All of this happens at a time when capital costs are rising and infrastructure constraints are tightening, and silver feeds directly into this problem. As silver prices rise, so do the costs of power transmission, chip packaging, and renewable energy expansion. That squeezes margins across the board. China, by contrast, benefits from lower production costs and closer alignment between state planning and industrial execution. This does not mean Beijing is immune to risk. Export controls can provoke retaliation and market volatility, but China is playing from a position of preparation. It has spent years building power capacity. It has diversified supply chains. It has accumulated strategic materials. The United States is now reacting, not setting the tempo. This is the deeper reason why semiconductor executives are uneasy. They are not facing a single policy threat. They are facing a system that is becoming more expensive to operate inside. AI growth is no longer limited by imagination or algorithms. It is limited by electricity, metals, and industrial throughput. If those inputs become scarcer or pricier, the entire growth narrative has to be rewritten. That is why silver matters. Not as a trade headline, but as a structural signal. The chip war is entering a phase where physics and economics matter more than rhetoric, and in that phase, preparation beats brilliance. Now let's zoom out and look at the industrial foundation underneath this entire confrontation, because this is where the imbalance becomes impossible to ignore. Advanced semiconductors do not magically create value on their own. They require a dense ecosystem of factories, suppliers, skilled labor, and logistics that can iterate fast and absorb shocks. This is where China holds a quiet but decisive edge. Over the past 2 decades, Beijing has built the largest integrated industrial base on the planet. When a new chip design emerges, China can test it, package it, deploy it, and adapt it inside real production environments almost immediately. That feedback loop is priceless. The United States, by contrast, has seen its manufacturing base shrink steadily. Tariffs raised input costs, labor participation slowed, factory investment lagged behind services and finance. As a result, optimization cycles take longer and cost more. This matters enormously for inference-focused chips, which depend on rapid iteration rather than theoretical performance. If a design flaw appears, China can correct it across dozens of facilities at once. In the US, fixes are slower and more expensive. And then there is the energy constraint. Data centers are multiplying, but power generation is not keeping pace. Grid bottlenecks delay deployment. Local opposition slows expansion. Energy prices remain volatile. China does not face the same limits. It is expanding fossil fuels, renewables, and nuclear power simultaneously. This abundance allows China to treat electricity as an enabler rather than a bottleneck. Combine that with cheaper metals and lower production costs, and you get a structural advantage that does not show up in headlines. This is why the silver restriction matters more than it seems. It compounds existing asymmetries. Higher silver prices make it harder for the U.S. to expand power infrastructure quickly. They raise the cost of transmission and renewable deployment. They slow the very systems that AI depends on. China is not winning by racing faster. It is winning by removing friction from its own system while increasing it for others. That is the core dynamic now unfolding. At the same time, silver itself is transforming from a background input into a strategic variable, and that shift carries global consequences. Silver is essential not only for chips, but for solar panels, electric vehicles, batteries, and advanced electronics. Demand is rising across all of these sectors simultaneously. When Beijing signals tighter export controls, markets do not hear a temporary trade measure. They hear scarcity. Scarcity changes behavior instantly. Companies begin stockpiling. Traders arbitrage across regions. Prices rise faster than fundamentals alone would justify. This is exactly what has been unfolding. Domestic prices in China have traded at a premium, pulling metal inward. That inward flow is not accidental. It strengthens domestic supply security while forcing external buyers to pay more. For the United States, this creates a layered problem. Domestic silver production exists, but costs are significantly higher. Mining expansion takes time, permits, and capital. In the meantime, industries face higher input prices. Those costs get passed along. Data centers become more expensive. Renewable rollouts slow. EV margins compress. None of this causes an immediate collapse, but it erodes competitiveness year by year. China, meanwhile, benefits from lower extraction costs, tighter supply control, and coordinated industrial planning. This is not a ban or a weapon in the traditional sense. It is a pressure gradient. Pressure gradients reshape systems quietly. Over time, they determine where investment flows and where it does not. This is why silver is now part of the AI and chip conversation. Technology no longer floats above the physical world, it is anchored to it. And Beijing is anchoring itself deliberately. The United States is only beginning to grapple with this reality. The danger is not sudden loss. It is slow disadvantage becoming permanent. So let's widen the lens one more time, because silver does not operate in isolation. It sits inside a broader realignment of global supply chains that is already underway. The world is fragmenting into overlapping economic blocks, each seeking resilience rather than efficiency. For China and its partners, securing access to raw materials is foundational. This is where BRICS and the Global South enter the picture. Many of the world's largest undeveloped silver and metal deposits sit outside the Western sphere. Latin America, Africa, and parts of Asia are becoming contested terrain, not militarily, but economically. Investment, infrastructure, and long-term contracts determine alignment. China's Belt and Road framework was never just about trade routes. It was about resource access and optionality. Ports, railways, and power plants create pathways for commodities to flow where Beijing needs them. The United States operates differently. It relies on markets, allies, and financial leverage. That model worked well in a world of surplus. It works less well in a world of scarcity. As metals tighten and energy demand rises, competition intensifies. Silver is an early indicator of this shift. It reveals how quickly markets can reprice strategic inputs when control concentrates. This does not mean the U.S. is powerless. It still holds immense advantages in capital markets, innovation, and alliances. But those advantages require time and coordination to translate into physical capacity. Time is the variable China is trying to deny. By acting early and incrementally, Beijing is shaping conditions before responses fully form. This is not escalation. It is preparation. The chip war is now inseparable from the resource war. And in that environment, nations that align digital ambition with physical control gain durability. Those that separate the two face compounding constraints. Now, we enter the scenario phase, because this is where choices begin to matter more than intentions. The first path forward is the most straightforward. If China continues tightening control over silver, while accelerating domestic deployment of inference-focused systems, then cost pressure in the West rises steadily. Not catastrophically, steadily. U.S. firms respond by trimming ambitions, prioritizing fewer data center builds, and focusing on high-margin use cases instead of mass deployment. The consequence is a narrower AI footprint. Powerful systems exist, but they are concentrated in finance, defense, and elite research. Meanwhile, Chinese systems spread widely across everyday infrastructure, healthcare scheduling, city logistics, industrial automation. Over time, that ubiquity creates a learning advantage. Real-world data improves models faster than isolated training runs. The second path is more aggressive, but also riskier. Washington reacts forcefully. Subsidies expand. Strategic stockpiles grow. Mining permits are fast-tracked. Energy projects are pushed through politically. This path restores some balance, but at a high price. Inflation rises. Fiscal pressure increases. Trade tensions escalate. The U.S. regains capacity, but at the cost of higher debt and social friction. China, in this scenario, absorbs volatility better due to centralized coordination. The third path is the counterintuitive one. Silver prices spike, then partially correct. Markets breathe, headlines move on, but behavior does not fully reverse. Companies keep stockpiles, governments maintain controls, trust erodes quietly. In this scenario, fragmentation deepens even without crisis. Systems duplicate, costs stay elevated, growth slows globally. No one wins outright, but those who prepared earliest lose the least. This is why silver matters beyond its price. It reveals how quickly optionality disappears when inputs tighten. The AI race then becomes less about who builds the smartest model and more about who can keep systems running reliably over decades. That favors planners over sprinters. At the same time, the financial layer cannot be separated from this story, because resource pressure always bleeds into capital flows. As silver and energy costs rise, investment decisions shift. Projects with long payback periods look less attractive. Venture funding becomes more selective. AI spending concentrates among the largest players. This consolidation benefits firms with state backing or deep balance sheets. China fits that profile well. The U.S. still has capital depth, but capital is more sensitive to returns. Higher input volatility raises discount rates. That slows deployment further. Currency dynamics add another layer. Resource-rich economies gain leverage. Import-dependent economies face persistent trade imbalances. Over time, this nudges the global system toward a more transactional order. Long-term contracts replace spot markets. Bilateral agreements matter more than multilateral norms. Silver, again, plays a signaling role. It shows how quickly financial abstraction collapses when physical scarcity appears. Digital assets do not power data centers. Metals and electrons do. This realization forces a repricing of what technological leadership actually means. It is not just code, it is continuity. Continuity of supply, continuity of power, continuity of cost. Beijing has optimized for that continuity. Washington is now adjusting under pressure. Neither side is guaranteed success. Policy errors remain possible. Overreach can backfire. But the direction of travel is clear. The era of cheap inputs is ending. In that era, speed mattered most. In the next era, endurance does. That is the deeper pivot underway. So we end where we began, not with panic, but with structure. The fear inside the U.S. semiconductor industry is not irrational. It is rational recognition that the rules are changing. The chip war is no longer a contest of breakthroughs alone. It is a contest of systems. Systems that align technology with energy, materials, and industrial capacity endure. Systems that do not fall behind quietly. China's move on silver is not decisive by itself, but it fits into a pattern of long-term preparation that is becoming harder to ignore. The United States still holds enormous strengths. Innovation, capital markets, alliances, but strengths erode when the physical base supporting them weakens. AI cannot escape physics. Data cannot move without power. Power cannot flow without metals. That chain is now visible. The future will not be defined by one winner and one loser. It will be defined by resilience, by who can absorb shocks without losing momentum, by who can scale without running into walls. Silver is simply one of the first walls to appear. More will follow. The question is not whether the U.S. can respond, it can. The question is whether it can do so fast enough and at acceptable cost. And the question for China is whether tightening control brings stability or unintended backlash. These are open questions. History is not predetermined, but the direction of incentives is clear. Control inputs and you shape outcomes. Ignore them and ambition stalls. Let me know what you think in the comments below. Can the U.S. adapt its AI strategy to a world of tighter resources? And does China's silver move signal a broader phase of economic pressure? Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.